Hi, I'm Joshua Wilson, CEO of Lake Point Advisory Group. I'm excited to have you for our online Food for Thought event, what you need to know to put healthcare to work for you. Lake Point Advisory Group is a retirement planning and wealth management services firm. We host these monthly events on a variety of topics that we hope are beneficial to our clients. We do have a large audience with us today, and thank you for joining. Everyone's camera and microphone is off, but we will take questions if you'd like to type your question by clicking on the Q&A icon at the bottom of the screen. Today, I'm glad to welcome Todd Furniss with us. Todd has over 30 years of global experience in private equity, consulting, operations, as a senior level operating executive. He currently serves as the CEO of GTC Group, a private investment firm dedicated to creating value for shareholders in the middle market, technology-enabled business services, financial services, and healthcare companies, and the correlated real estate. In the last 12 weeks, Todd has been on fire with his new book. His podcast views have been over 130,000, and he's had over 13 million media impressions. Now, I've known Todd for many years now, and his life circumstances have really given him vast experience with the healthcare industry from multiple perspectives, and they lead him to develop a real passion for healthcare. He has a strong desire to address and rectify our current system's shortcomings, and Todd, that's a lot of those. Todd has been featured as a guest headline healthcare expert for Fox News Radio, ABC TV News, the Scott Becker Private Equity Podcast, Bullseye Brief, and the Jim Bohannon Show. Todd hosts his own podcast titled Civil Discourse, and recently wrote a book about healthcare reform titled The 60% Solution, Rethinking Healthcare. He's published articles from Healthcare Reform in Authority Magazine, Inside Sources, Grit Daily, and the Dallas Morning News. Todd, what a time to be talking about healthcare. Todd, it just, from a financial planning perspective, it feels like to me that the government is doing everything they can to raise the prices for our clients. When we think about long-term planning, we think about the costs that are coming, but man, it just seems like the government is not on our side, and they seem to be making things more difficult. I'm hoping to glean some things from you today, Todd, on what we can be doing with our clients and what our clients can be doing in their own lives to improve, not only improve the quality of their healthcare, but also get it at a much better price. Todd, you've got a big job today. Thank you for being here with us.
Thank you so much for having me, Josh. It's a delight to be here with you. And I've got to confess to the audience that I've known Joshua long enough that I can call him Josh.
Yeah, that is something that my friends know about me is I'll answer to Josh. I'm kind of formerly Joshua, but yeah, Todd, we have been friends for a long time. Okay, again, thank you for being with us. Todd, give us a start. First of all, tell us about the current state of healthcare in the United States and what are maybe our biggest problems we're facing.
So I could probably spend 2-3 hours just on that question alone. So I'm going to give you one really simple answer. And this is perhaps not well known, but if you think about it just for a minute, it makes crystal clear sense. When you go to the doctor, the first thing you ought to say is, how many people are in that relationship with me? I go to the doctor, and first thing I ask is not how much does the service cost, it's how much is my copay or how much is my deductible. So that means the insurance company's in the middle of that relationship. That insurance company then has the ability to instill what I call commercial regulations, meaning they're only going to reimburse the doctor if the doctor follows the insurance company's rules, not healthcare rules, the insurance company's rules. In addition to that, the doctor has to be licensed. That's been around for a long time. Licenses come at the state level, not the federal level. That means the state government's involved with you. If for some reason you're on Medicare or Medicaid, that means the federal government's involved with you. So all of a sudden, instead of having a one-on-one relationship with a doctor, you now have several people in that relationship. And what I've been trying to drive is this concept of, this time honored called consumerism, We need to have a direct relationship with the provider that we're dealing with, and that provider ought to know who we are. And if you think about it, a cash payment is frequently going to be at a lower price, meaning that the provider would take a lower price for that service offering than if the provider has to go through the insurance company. Because if he or she has to go through the insurance company, they have to file a claim, they have to get the codes right. If they don't get the codes right, they could face civil and potentially even criminal liability. Then they got to wait for the payment. If the payment is done on the first instance, that's wonderful, but it's still 60 days out. So there's a cash flow issue. And it could be either 90 to 120 days out, but it could be rejected altogether, and you may have to file the claim all over again as a doctor. So cash on the barrelhead is a powerful tool. So to make matters only worse, the reality is you don't know who your doctor works for. Over the course of the last several years, for example, United Insurance has been buying physician practices. So United now United now employs, directly or indirectly, over 50,000 physicians. So does that mean you're going to see the insurance company when you go to see the doctor? What about the conflicts of interest that are implicit in that? Who's the duty of loyalty to? Who does the primary relationship exist with? And if it's not the insurance company, then maybe it's the hospital. If you're now in the hospital's framework of physician or care providers, then what does that mean? So we've lost the plot here in terms of the direct relationship between buyer and seller of services. And that's, if I distill everything down, if there's only one takeaway from this entire conversation, that would be the most important takeaway, is we don't have a direct payment relationship with our provider.
Well, so basically what you're saying is when we speak to a doctor, we tend to, because of the convenience that we've sacrificed in, just hand my insurance card or Medicare or whatever, because of that, there's so much going on in the background that it's actually stripping us. That convenience is coming at an extremely high price. Is that right?
That is exactly right. So before we started today, I gave an example that was one of the more egregious examples that I've heard. Unsurprisingly, I now have access to a whole bunch of data on prices. And part of that's because the prior President Trump issued an executive order mandating pricing information be made transparent. And prices are different, unsurprisingly, for what we call the BUCAs, which is Blue Cross Blue Shield, United, Cigna, and Aetna. Those are the four biggest payers. And what we found is that two things. One, we have essentially an oligopoly, meaning it's a concentration of power in those four companies as payers. And then similarly and conversely, we have a concentration in almost every urban market of the providers. There are about 3 or 4 providers in every market, and only 3 or 4 providers of consequence. So by way of example, here in the DFW Metroplex, there are 3 companies, 3 providers that control 91% of the market. It's Baylor, it's HCA, and it's THR. Now, if you add Methodist in there, it's 98% of the market. So what kind of negotiating power do you really have? Not a whole lot. But having said that, prices that are charged by any one of the 4 providers are different to each of the 4 payers. And so I'll give an example that's not DFW based, but in one case, we found a dialysis syringe, just the syringe, not the dialysis service, but just the syringe.
Just what goes in the arm is all.
Exactly right. Which would cost $5 to purchase, was being charged to the insurance companies, and they were paying $6,000. So the idea that this is that anybody in the industry is genuinely interested in cost reduction is, I think, a confidence misplaced. So I think we need to figure out, and this is one of the things I advocate in my book, is how is it that we take more control of our own circumstance and drive prices down ourselves as empowered patients who are focused on better outcomes, direct relationships, and taking care of, and taking a greater responsibility for caring for ourselves.
Well, Todd, I think a lot of us may I understand what you said about the really only being 3 to 4 major providers, but I think a lot of us would still say, "Hey, my doctor's a great guy. I trust my doctor. He's a great doctor." But what are we missing when we focus on the quality of the doctor that we're choosing? What are we missing?
So you'll notice I didn't say anything about the doctor being a good doctor or a bad doctor. I'm saying, what is the context in which that doctor operates? And what I'm advocating is you change the context proactively. And how do you do that? I propose that instead of saying to the doctor, I'm going to pay you with insurance, you say to the doctor, I'm going to pay with cash. That means it's really clear who's responsible to whom for what. You're gonna give me a service, you're gonna take care of me, and I'm gonna pay you cash for that, which is better for both of us. You get the cash now, and as a result of that, I get all of the education that's associated with that, and you don't have to file a claim.
But Todd, that's pretty scary to hear to say I'm responsible for something that I don't know that I know the costs of.
I love that question, and I'm grateful for you for asking that. You may be the only guy, because I know your background from Alabama, but you may be the only guy on the call that actually knows how to change the oil in your car, right? I can tell you, I have in the past changed the oil in my car when I was young and impetuous, but I can tell you now, I don't have the foggiest idea to know how to change the oil in my car. But that doesn't prevent me from knowing how to get my oil changed, does it?
That's right.
I can go to the dealer and I can say, okay, what are you going to charge me for the oil change? And they'll give me a price. And I can go across the street to Jiffy Lube and I can say, hey, Jiffy Lube, I need an oil change. Can you give me a price? And odds are very good that the Jiffy Lube franchise is going to give me a lower price than the dealer. And so I do a risk reward analysis. And I said, well, would I rather have the support of the dealership if something goes wrong? And what's the probability of something going wrong? Or would I rather go to Jiffy Lube and pay a lower price and not have the support of the dealership? So I can do a risk-based analysis. I don't have to know how to change the oil in my car. But guess what? I also don't have to worry about whether or not I'm going to get a surprise bill from the guy who actually changed the oil because he was out of network. And so now, because he was out of network, they're gonna the dealer's gonna now send me an ancillary bill for the out of network oil change guy. That's in addition to my cost for the oil change itself. I don't have to worry about that. I also don't have to worry about the fact that I'm going to get a separate charge for the oil itself that's been upcharged. And I don't have to worry about getting the oil filter charge in addition to that, right? I got a one flat fee. The P&L is a responsibility of the dealership or the Jiffy Lube in each case, and off we go. But that's not the case in healthcare. And what happens, and I've countless examples of this. A friend of mine goes the other day, it is a couple months ago. His wife is suffering extreme abdominal pain. Doesn't know what the issue is. She goes to the emergency room. And he has the prescience to say to when he calls the ER to say, "Are you in network for my provider?" And they say, "Oh yeah, we're." So he goes into the ER. Turns out she needs to have her gallbladder removed, emergency surgery. So she gets her gallbladder removed by the doctor in the ER. All good, covered by insurance, right? And not so much. The doctor who performed the surgery was out of network. So he gets a $30,000 bill. Gets worse. Guess what? Anesthesiologist, out of network, gets a bill for the anesthesiology, $5,000, right? So where on earth did this become permitted? Now, the way to counter that is to go back and say, I have no privity of contract. You have no contract with me. I'm not paying you. So if you want to charge me something reasonable, we can talk about that, but I'm not paying you because my contract is with my insurance company, which has a contract with this provider, and I am not paying the out-of-network charge for the physician who performed the surgery or the anesthesiologist. That'd be an example of something that you could worry about. But what I propose is using tools that are currently available to us to make cash available so we move away from the current model. And what do I mean by that? If you think about what's going on right now, we have created healthcare insurance, which Devin Herrick, who's a healthcare economist, called the current model of tax deductions for benefits for employers a perversion of tax policies that has existed for 80 years because it started under FDR. So what's happened is we've created insurance to be a model of a layaway plan for healthcare. In other words, we've encouraged people not to take any personal responsibility for their health necessarily, other than you just don't like feeling not good. But we've taken the position that anything you do is going to be covered by insurance subject to your deductible or your copay and your premium. And so what we've done is we've moved the responsibility away from the individual to the insurance company. And it gets worse because when you think about it, what is an insurance company? An insurance company is somebody who takes payment to protect you against something that is statistically improbable to occur. Right? Running joke in the industry is that everybody thought the insurance guys were the dullards and not very bright. Those are the smartest guys in the world, right? When you think about it, they're getting you to pay for something that you are hoping never to use, and they're hoping never to have to pay for.
Wow.
Right? So it's a little counterintuitive. So what I'm saying is, hey, let's use the tools designed in the form of flexible savings accounts or health savings accounts. Let's move some money into those areas, and let's take the money that's invested in those accounts or that's in those accounts and invest it. And what happens is you can move a certain amount of money every year. It's characterized individually and per couple under the tax code. Let's move the maximum amount of money. And when you do that, it reduces your taxable income. So there's a tax advantage to doing that. The second thing is that any money you make in terms of dividends or capital gains, ordinary income, whatever, that inures to your benefit by virtue of the dollars invested inside of that HSA are also enjoyed tax-free. But the challenge is you can only spend that money on healthcare expenses. So the trick is, and the way to really kind of double down on making this work is you put as much as you can into your HSA, you invest that money for a good organization like Lake Point, and then that earns a return and it grows. At the same time, what you do is you move your deductible to as high as you feel comfortable. And I'll give an example. My son, and this is a little bit of an unfair example, but it's using hyperbole to make the point. My son was 30 years old. He was unmarried, had no kids, obviously. And so I said, hey, John, what are you paying for your insurance? And he told me the number, and I was stunned. And I said, what's your deductible? He said, my deductible is $10,000. I said, what are you paying monthly for your premium? He says, well, I've got a pretty good plan. It's $86 a month. Now, the reason he's able to get the $86 a month is because he's got the $10,000 deductible. Now, the question is, lots of people can't afford a $10,000 deductible because they might not have that cash on hand. But if you start moving money into your HSA, then you can have that money available in the event that you have a need for such a deductible to be met. But your insurance premiums are going down. So you're essentially creating your own second dividend on the capital invested, right? So let's imagine you put the maximum amount of money available into your HSA, which is currently about $7,200 per couple. And you can put more money in, and it just won't help you with your tax numbers. But then let's say you move your deductible to as high as is possible and you have a $10,000 deductible. Your monthly premium will go down so precipitously that it's effectively operating as a dividend on your HSA contribution, because now you have more free cash because you don't have to pay that money in premium. And whether it's 100% of the premium that you're paying individually or a portion of the premium because your employer is matching, either way, you're creating what I would call effectively a dividend by virtue of what you're doing.
And we'll need to distinguish between employer plans and those who are already retired, but let's start with one. Those who are currently employed. All plans don't offer HSAs, Todd. I'm not sure, that's not my area of specialty of why some do and why some don't. Are you kind of somewhat advocating? Obviously, everyone's situation is different, but can you speak to that? The different plans and some offering HSA and some not.
Yeah. So what the code actually
is for healthcare savings account.
Yes. And so what the code actually says is you can only have HSAs used when you have high deductible plans. And high deductible plans are anything over, I think, $1,300 per person, or I think it's $2,600 per couple. And so what you're trying to do is you're trying to encourage people to, if you don't have that available with your employer, go ask them for it. Go be just ask and be an activist to some extent. I'm not saying you be improper or uncontrolled in your request. I'm just saying, hey, guys, go reach out to your HR person or your benefits administrator and say, hey, I'd like to have the ability to use HSAs. And so what are we doing about that as a company? What are we doing about supporting individual and personal responsibility? And let's see if we can move down that path. Because at the end of the day, there are all sorts of things companies can do to save a tremendous amount of money. And this is particularly true with self-insured companies.
Well, talk to me about that for a second. You know, obviously, smaller businesses in particular are devastated by the rising healthcare costs. You know, if you're AT&T, you can easily absorb that and continue to offer those benefits, and the employees have the benefit of not knowing the difference. But small firms, which employ over half of the United States population, they're the ones that just get absolutely stunned by these rising healthcare costs. And even if they're matching, 50% of the coverage, for example, the cost of doing business is going up, and then of course the employees got to take some of that, which makes those employers less competitive. Is there anything that a small employer can do?
Absolutely. And depending upon your size, to the extent that you can become self-insured, which some smaller companies can't afford to do either, but to the extent that you can use self-insurance, then you actually are in a position to drive your costs down. If you think about it, what is, roughly 83 to 85% of our economy is services based, right? And so that means that your number one cost in all probability, or number two cost, is likely to be people. And of your people cost, about 20% of that or 25% of that is going to be benefits. So it's a huge item on your P&L. So unfortunately, what happens is, because it's so technical, CEOs tend to hand this off to the HR leader and say, go solve for this. And the HR leader usually usually takes it on, but the CEO doesn't really know what the HR person does. And so I've taken the liberty in the last couple of months of saying to about 24 CEOs, hey, where do you get your health insurance? And the answer is inevitably incorrect. So here's a quick little example. I'll say to the CEO, where do you get your insurance? And he says, oh, we get it from Blue Cross Blue Shield. I said, nah, no, not really. He said, what do you mean? I said, well, you get it from your employer. Your company pays for provides you with insurance as a benefit. Oh, well, okay, yeah, right. I'm sorry. And I said, where did your employer get it? Blue Cross Blue Shield. Not so much. I said, he says, what do you mean? Well, you got it from a broker. And the broker gets it from the carrier. Well, how does the carrier establish premiums? The carrier establishes premiums with the State Department of Insurance. So the result is, not only does the employee not have any ability to negotiate with the carrier, the employer has very limited ability to negotiate with the carrier, because the carrier's premiums have been established by the State Department of Insurance. And the State Department of Insurance is operating on what is essentially a cost. I mean, I'm oversimplifying this, but it's essentially a cost plus model. What you're doing is you're saying, I've got a loss ratio that's a fixed percentage of the amount that I'm taking in. And then anything beyond the loss ratio, I as the employer get to keep. I as the carrier get to keep. And so that, and in many states, it can be as high as 35% of the premiums collected. It's a huge number, a huge percentage. And so if you start digging in to the amount of money that these executives are making, or the way that they're paid in terms of option value, which is based on the value of the stock, that then is valued as a multiple of the EBITDA. Every dollar that falls to EBITDA or earnings is then multiplied by by the purchase price multiple. So they're not necessarily encouraged to shrink that percentage, and they're not really encouraged to shrink the number overall, because it all comes back in the form of compensation, and the compensation numbers are staggering. But also, if you take a look at the investment opportunities, if you look at the the value of the stock price for the major insurance companies versus any of the major indices, they just beat the heck out of them. I mean, it's like not even a fair race. And if you take a look at the earnings calls for any of these companies over the course of last year, the numbers are staggering, ranging from 2-3 billion to $5 or $6 billion of earnings per quarter. It's just remarkable.
Wow.
So by at the same time, you can, the other side of the coin is you can hedge by investing in insurance companies.
Todd, when you start hearing about these exorbitant salaries and this exorbitant costs, and it starts to feel like an indictment against capitalism itself. What has the government done to enable these things? And really kind of, and so at least by my figures, it seems to me like the government's not just enabled, it's mandated these sorts of things happen. Can you speak to that?
You bet. So first thing is the way that we have the first anomaly that gave rise to this, and I'll give you some facts and figures for it, really started, as I mentioned earlier, under FDR. FDR in 1943 said, oh my gosh, we're getting ready to go into a world war. We're going to need labor out the wazoo, and we're going to have labor inflation that's uncontrolled because there's going to be competition for talent. Well, to put this into perspective, in 1944, we had a 1.3% unemployment rate. Now, that sounds amazing, but it's more amazing than you think, because we had almost 100% participation in the labor force, and the labor force included everybody over 10 years old.
Wow.
Yeah. So today, the labor force only includes people, I think it's over 16 and goes to 65, and you have to have all these bells and whistles in terms of your qualification for being in the labor force. But even with that, our labor force participation rate is only about 63%.
That's been falling, correct?
Yeah, exactly right. Now, without getting into contemporary politics and unemployment issues and supplemental payments and that whole 9 yards, let's just stick with the health insurance anomaly. So in 43 or 44, FDR comes out with this stabilization plan and caps wages. That was but what he did is he said, you can't pay people more, but you can give them benefits in the form of insurance. So we're going to let the companies who provide insurance as a benefit to their employees deduct that as a business expense, but we're not going to tax the recipients of that benefit on income. So the current cost of that one issue of not taxing the recipients of the benefit is worth $500 billion. Okay, so that issue was again adopted and put into law again in 1954, and has been in place ever since. Now, before FDR created that law, only about 10% of Americans had health insurance. Today, people who are in the workforce and employed, it's about 90%. So the reason I call the book, in fact, I have a copy here. The reason I call this book The 60% Solution is because about 20% of our population is on Medicaid and about 20% of our population is on Medicare. Everybody in the middle is primarily on some form of private insurance, likely obtained through their employer. So that's how we got here. And there are all sorts of things that have happened over the course of the years that kind of entrench that, ranging from who can get a license to be a doctor to the practice of medicine. But what happened, there are a couple of things that give us some measure of hope. In 2003, a guy named John Goodman worked with President George W. Bush to implement something called the HSA. And that started the ball rolling. The IRS then adopted that in the code, and it's been in place since that time. That's a good news story. The second good news story is the pricing transparency that happened under President Trump. Now, people might say, hey, well, Todd, you're not really talking much about the ACA. And you're right, I'm not, because what that did is it really catalyzed consolidation in the industry. It really allowed companies to aggressively acquire one another. So the big ate the small and became bigger. And then we had a concentration of industry and competitive capabilities in larger companies. So there are some good things about the ACA. There's some not so good things about the ACA. But today, we just want to lend our focus to how we can help people pay for their healthcare and kind of make money out of it, if you will.
So that's a good point. And so I'll circle back then to, we talked about employers offering HSAs, and obviously you advised, considering at least a high deductible plan, which would make someone eligible for the HSA. And if your employer doesn't offer such a plan, maybe go to HR and ask for that option, so you can make that, they care about that. What about those who are already retired? Is HSA an option for them?
It is, and you can use HSAs in that instance for the same reasons. You'll have, because Medicare, most people are on Medicare who are going to be over 65. You may have a particularly affluent group who's elected to retire early, in which case they're not 65 yet, so they may not be eligible for Medicare. But in that instance, you still are paying a premium, and you're still somehow likely getting some form of insurance, and therefore you can use HSAs to change your deductible and make it those numbers higher. What's astonishing to me, and not such a little amount of astonishment, quite honestly, is that the HSA numbers, in terms of the maximums you can put away, don't necessarily map to the maximum deductibles. So we've got some work to do as an industry in terms of matching those and getting the highest deductible possible. For many companies, that's just not available. But I would encourage that, and I would encourage the use of HSAs to the extent possible. If companies are feeling even more aggressive and more generous, and they want to do more for their employees, I would encourage a combination of what's called flexible spending accounts and health savings accounts. And there's a slight difference there. If you'd like to, we can talk about that, but that's another way of further dampening the blow of the cost of healthcare.
You've mentioned several of the benefits of the HSAs, but one of the things you had mentioned to me, I think in a prior conversation maybe, is that only like 10% of Americans use them. Why is that?
Well, one of the common complaints is that HSAs are difficult to really get into, either because the cost of the administration is high, or alternatively because people who might be interested don't make enough money, right? So I had a conversation yesterday with somebody who said, yeah, but HSAs really don't work for somebody who's only making $35,000 a year. Well, that's not going to really pertain to your client base here. But I advocate a different solution for that, which still encourages HSAs, but has a matching function coming from government to encourage consumerism and fund those HSAs with cash coming from other sources. The other thing is that, while you can say HSAs are not really helpful for people who are making less money, that's to some extent also a little bit of a red herring, because anybody can put money into that HSA. It's not just the employee themselves. So the employer can contribute to the HSA, family members can contribute to the HSA, and others can as well.
I love it that you're encouraging us to be more aware of where our healthcare dollars are going and understand what's behind those things. It's kind of like you're encouraging more consumerism in the industry. How does that consumerism really benefit the consumer? I mean, it's kind of that shop around mentality and ask more questions. Can you give me an idea of some of these consumer questions that we should be asking, and who should we be asking them to?
Well, you should be let's imagine that you've taken my advice and you've gotten an HSA. Now all of a sudden that's your money. That's your money. Josh and his family get to roll whatever you haven't used in 1 year to the next year. So if today it's $10,000 or $5,000 and you've only used $1,000, that means you can roll $4,000 to next year. That's exciting news, because guess what? You get to contribute another $7,200 on January 1, or your employer can if they want. And now all of a sudden you have $11,200 in your HSA, and the next year it could be more, and so on. So, but you get to keep whatever's in that HSA that hasn't been spent. So now all of a sudden you go down to you say your doctor tells you need a blood test. Okay, well, I'm going to get a blood test. You go to LabCorp or Quest or one of the other providers, and they say, you ask the question, what's the cost of the blood test? And if your insurance company is paying for it, it could be anywhere from $175 to over $1,000 for the blood test. I've seen prices, and I'm not making this up, as low as $11 for a blood test. So now all of a sudden you say, well, okay, I can't get it for 11, but I can get it for 100 instead of the insurance company paying 175. I'm going to pay 100. I'm paying that out of my pocket, out of my HSA, And that's all good, because now I've still got, I've saved money on the purchase of that blood test. And the same happens with x-rays, MRIs, CT scans, dialysis, doctor's visits, everything.
I kind of learned this on accidents. A few months ago, I'd gone in and I wanted, and my doctor recommended, let's do a battery of tests. Let's get all these blood tests. And I was all for it, just total health. And as I was on the way out, hey, do you want to use your insurance? And because I didn't have my insurance on file or something. And so I asked, since it was just blood tests, well, is there a cash price? And she said, yes, we actually have a negotiated fee with LabCorp. It's $150. And so I said, well, I just rather, that's fine. I just take it. So I swapped the card. Well, turns out the biller made a mistake and ended up submitting it to LabCorp anyway. So I ended up getting a bill from
sending it to your insurance company.
Yes, send it to insurance company. Anyway, obviously the doctor, they straightened it out afterwards. But anyway, as my story goes, I ended up getting a bill from LabCorp for like $3,200. And of course, I called the doctor, and they saw it, and they straightened it out, and they got that bill removed. But it was just that simple of, do you have a cash price? Do you have a negotiated price? Yes, we have a negotiated price with LabCorp. It's $150.
And,
I mean, maybe I could have asked for a breakdown and tried to get it even, but for me, that was an out the door price. That's easy to take. And yeah, what you just told me is worth over $3,000 just on those blood tests.
And think about it. All you did was ask the question.
Yeah.
It wasn't, you didn't have to be embarrassed to ask. You didn't feel like you didn't have the right to ask. You said, hey, by the way, is there a cash price on this? As though, I mean, it's just another question. It's just, nobody should be intimidated, because I think this is one of the other problems is people feel so anxious. We started this conversation by talking about what I call the asymmetry of knowledge, right? You don't feel like you know enough about healthcare to ask good questions. And you know what? It's really tragic is the industry reinforces that idea. That's really tragic. The industry is telling you, and this is one of the why I would hate for single payer to ever come about, is because that's the ultimate manifestation of the industry telling you and government telling you you're not smart enough to figure this out, and only we are.
Yeah, the government pushing, forcing this, and obviously it caused a lot of the big dogs to gobble up the little ones. And I cannot imagine what going from 4 carriers and DFW to 1 would go to prices, and of course profits too. And it's interesting because we tend to, one side of the aisle tends to focus on the free market, and the other focuses on the government. But the fact is crony capitalism is the government getting involved in capitalism. It's not one or the other. You literally can't put it just on one side or the other. It is when powerful politicians start dictating and telling businesses how they have to run that these oligopolies and ultimately potentially monopoly, that's the enabler of these things to come about.
Well, and think about it. Then they amass enough cash. Guess what they get to do? They get to fund politicians' campaigns, and they get to hire lobbyists. I don't know about you, but I've never in my life been able to afford a lobbyist. And I don't know anybody else who has, but that's not something I'm going to do. But I think one of the things that also people should realize, one of the things I've heard from people in the past is, yeah, but I go to a faith-based hospital and they're a not-for-profit. That's just the biggest red herring ever, because the running joke that I heard once from a nurse ethicist, if you can believe this, was that no margin, no mission. Oh. And the other question was, the other comment was, everybody makes a profit in healthcare. It's just some pay taxes and some people don't. And wow. If you take a look, if you dig into the numbers, you'll find that the amount of indigent care provided for non-for-profits is dwarfed by the amount of tax savings that they get as a result of their nonprofit status. So don't be misled into thinking that not-for-profits have this greater and more noble ambition. They're businesses too. And what it just means is that any surplus is being used for other purposes. Usually and frequently it goes into management salaries. But I will say one of the things, my first guest on my podcast was a delightful, one of my dear friends, Dr. Jim Dennison, who happened to be happens also to be not only a theologian, but also an ethicist. And I asked the question in the podcast, is it moral for a service provider to profit from rendering services to a patient? Because to me, it's a gating question for all business models in the industry. And the answer, unsurprisingly, was yes, because that funds innovation and talent and a bunch of other things. But there are lots of people out there who are now trying to assert that the answer should be no. And that has all sorts of negative implications for the industry and for our country.
Wow. And folks that are listening in, please take a moment. If you have questions for Todd, please feel free to contribute them. I will continue talking to him for a bit longer, but I do want to give you all an opportunity to hit Todd with your tough questions as we chat. Todd, we beginning this conversation, we talked about HSAs, and you kind of went through the benefits. I'd love it if you kind of circled back on that and slowly give us kind of like the couple of bullets of this is what it is, this is how it's different, and this is why it may be advantageous.
You bet. So an HSA, or a health savings account, is an account that you get to put money into, and the money comes in a tax-free basis. And what it does is it lowers your taxable income by an amount equal to the amount you put into your HSA. So if you say,
kind of like a traditional IRA or 401k, but it must be used for healthcare.
Exactly right. You nailed it. And you can contribute up to a certain amount. That number changes every year. So you should always check with your benefits provider or alternatively your accountant. But the number changes every year, and it's unique to the individual and to a couple or household. So I believe the number currently is maxed out at $7,200 per couple in terms of the amount of income you can take this year and put it into an HSA. Now, you can put other money into the HSA that's from your balance sheet and not related to income, but it won't reduce your income other than the $7,200, which will reduce your taxable income. So that's the first thing. The second thing is that money can be invested. Meaning it can be invested out of the HSA account itself into securities, bonds, certificates of deposit, whatever you want. And the earnings realized by that investment are also tax-free. So the account grows with the earnings. And then it's owned by the employee, the individual, and it rolls from 1 year, any surplus rolls from 1 year to the next into perpetuity. And you won't be taxed on that money unless you use it for non-healthcare purposes. And that's about it. So again, it's very basic. It's a great model for reducing your tax obligations, but also for providing for your healthcare expenses in a tax-advantaged way. And it's really unfortunate to me that not a greater percentage of our population is not taking advantage of this today.
Todd, that was a great explanation and a great, I appreciate the bullet by bullets. But what about some mistakes? It seems simple enough, but are there mistakes we should look out for in using health savings accounts?
Sure. Well, you got to have confidence in your administrator who's administrating that. You got to make sure they're reputable. And there are plenty of places to find reputable reputable administrators for your HSAs. Usually that'll be done in coordination with your benefits provider. They'll have a plan and an administrator associated with that. The second thing is you got to make sure you don't spend it on stuff that's not healthcare related, because you don't want to get into a place where you suffer an audit or something else that would be time consuming, and you might have to pay a penalty on that. But aside from that, it's hard for me to understand why people wouldn't want to do this. Those are just the two major issues. Make sure you spend it on healthcare, and make sure you have somebody who's trustworthy. And then, also you want to make sure that your money that's invested isn't tied up in a way that you can't use it if you need it.
Yeah, I'd imagine that if someone's starting a brand new HSA, Todd, that that option to invest is probably not one they should take advantage of early on, because they may be using that. But as the balance grows over years, when it's not used, then maybe investing those dollars may be something they can consider.
And it's going to depend upon the affluence of the individual, right? If they are putting more money into the HSA, then they might want to invest right away. If they're, a starter family and they want to put as much as they can, but they don't have a whole lot of extra cash lying around, like many of us, then they may want to start off a little bit more slowly and invest in year 2 or year 3 rather than year 1. But they still get the benefits of the tax advantage, and they should also immediately get the benefits of a reduced premium because they've got a higher deductible plan.
Wonderful. And you mentioned earlier a flex spending account, and I don't want to get too far off on something that's not the main topic here, Todd, but would you briefly maybe tell me the difference between the HSA and the flex spending account, or the FSA?
Yes, thank you. And I actually go into those in my book and give you a little chart that kind of gives all the differences between the HSA, the FSA, and the HRA. But the FSA, just to talk about it real quickly, is the amount that the employer contributes into an account. You don't have any control over it as the individual, other than you can spend out of it for certain expenses, virtually the same expenses that are covered by an HSA are covered by an FSA. But additionally, it's owned by the employer. So whatever you don't get to keep, whatever you save over the course of the year, whatever's left at the end of the year, does not roll over to your benefit. It rolls over to the employer's benefit. Those are the biggest differences.
So the HSA is something that can follow the employee. The employee really owns the money. And that's one of the benefits of it, is that the employee really owns the money. If they changed employers, that could follow them to the next employer, just like a 401k could.
With an HSA, it's
Right.
always the employee's money. With an FSA, if you leave, the employer keeps the money.
Right. Big difference there.
Yes.
So, obviously, you made a compelling case for the use and the growth of HSAs. Is there anything we should be thinking about encouraging as constituents? What should we be encouraging our policymakers do to help encourage increase the use of HSAs?
I'd like to see them be more flexible. And a great example, especially given that you're a wealth management firm, is I would love to see the ability of HSA owners to have more flexibility in to whom they can give those HSA dollars, not in terms of providers, but in terms of successors. So right now, if I die, for example, I can only leave my HSA to my spouse. I would like to be able to leave my HSA to my kids. And that would be an example of giving somebody a leg up in the future, where, again, can only be used for healthcare costs. Well, I would like to be able to use that, give that to my kids. And that would probably be the biggest one. The second one would be expanding the amount of money you can put into your HSA. I think that would be powerful. And I think if we tweak some of the tax rules to allow that, that would be enormously beneficial. Now, there is one other thing that I will share with you, and this is incredibly, it's going to hit the news wave soon. I just released a podcast on this, which is this concept that I referred to earlier, called indexing. One of the problems we have at the lower end of our socioeconomic spectrum is, for people on Medicaid, you qualify for Medicaid until your household income is $51,000 a year. Well, that's, society and government has decided that's the good thing to do. And so let's assume that we're not going to change that. I'm not advocating a change. I'm just talking about how do we make that a better approach to healthcare. So nobody asks the question, well, what happens if somebody gets a raise? A pretty good raise right now is 5%, right? So if I get a 5% raise on $5,100, that's not going to really cover the cost of healthcare that I've now incur because I'm no longer on Medicaid. So the average cost for a family of 4 of healthcare is roughly $20,000, $25,000. So I've increased my gross income by 5% of $51,000, but I've increased my cost by $20,000 to $25,000. So I've essentially gone into what I call purchasing power purgatory. And so what we're seeing in those ranks is that people are turning down the raise. Right? In other words, they're turning down increased income opportunities. They're turning down increased professional responsibility or vocational responsibility. They're turning down job opportunities because they can't afford not to get Medicaid. And they're terrified not to get Medicaid. So what I've advocated is this combination of personal responsibility and government support. It says, look, what we ought to do is we ought to encourage people to put money in an HSA starting whenever they can. And let's imagine it's $25 a month. And then what we ought to do is we ought to say the government institutions are going to match that on a 5 or 6 to 1 basis. So let's imagine that it's $25 a month. 6 times 25 is $150. So now instead of having just $25 in your account, you have 175. 25 plus 150 is 175. And then multiply that times 12. That's now you've got a real number, right? You're over $2,000 a year that you've got accrued in your HSA. Whether you use that or not, because Medicaid covered your costs, you're now building yourself an off-ramp to get out of Medicaid and be able to use a high deductible plan to cover your costs at a lower rate. Now, the question would be, well, Todd, how are we going to pay for that? It might not surprise you that I would suggest that we already have a regressive tax policy by not taxing benefits, and that's costing the U.S. Treasury $500 billion. So that's an easy fix that would easily pay for the indexing and make everybody and create far more consumers of healthcare in our country today.
You know, your mention of Medicaid, reminds me of obviously Medicare, and a lot of retirees run into that problem where they're not really sure how to avoid those Medicare surcharges. Any recommendations you'd have for retirees and how they can be mindful of their income in retirement to avoid those Medicare surcharges?
Well, I can't go into too much detail. I would just argue that getting kind of Plan B and some of the other supplemental plans is usually a very, very good idea, and it usually makes a great deal of economic sense. So I would encourage some inquiry there, because most of the people who are over 65 feel very differently from those who are on Medicaid. For Medicare recipients to say, look, I paid into the system for now 30, 40, 50 years, so I'm just getting my own money back. And they don't feel the same way about that as they do Medicaid, who are people who haven't paid in the system yet and are getting a benefit. So I would say, look into supplemental plans that allow you to avoid some of those surprise costs.
Very good. Well, as we actually have a question here from Vicky for Todd. Todd, once you retire, can you keep the HSA?
Yes, you can. The HSAs are yours forever. Whatever you have in your HSA is your money, and you can spend it on healthcare expenses as long as you have a healthcare concern. And hopefully that means, and then when you don't have healthcare concerns, you can leave it to your spouse.
Awesome. Well, Todd, we have a few minutes left, so I really appreciate you coming on. I know your schedule has been very busy. Luckily, I could pull some friend strings and get in on some of this, and to have someone with 13 million views in the last few weeks and on Fox and those sorts of things. It's been a real privilege to have you, Todd. Appreciate your time quite a lot. But take just a moment, if you wouldn't mind, Todd, and just tell us a little bit about your book. What can people expect from, obviously there's going to be overlap with this podcast. What would they expect to learn more of it in depth if they were to be interested in?
Well, thank you, Josh. And it's always a pleasure being with you. I always love the conversations we have. And this is another example of one of them. I advocate 5 major points. And I start off with a very personal story. And if you don't care about healthcare, you may or may not care about the first story. I'll give you a little bit of a hint. When I was 17, unfortunately, my parents were involved in the worst aviation disaster in the history of the state of Georgia. They were on a commercial airplane going from one place to another, heading to Atlanta. And as a result of that, they hit some weather. Bad things happened with the engines. Bad things happened with the brakes, and as they lost power, they had to crash land. And the good news is the pilots did a fantastic job of crash landing the plane. The bad news is because the brakes had gone out, they couldn't stop the plane, and they hit a propane tank it exploded. The vast majority of the passengers were immediately killed. My father was killed immediately, and my mother fortunately lived, but unfortunately suffered immensely. She had over 2/3 of her body was covered with third-degree burns. She had amputations and broken bones, and had 100 major operations in the first, before she left Grady Memorial Hospital in Atlanta. She was hospitalized no less than once every year for the next 4 decades of her life. So I learned about healthcare from that perspective. As a 17-year-old, looking after my mom, I had my grandmother was very helpful. My uncle was very helpful. I had a sister that was very helpful. So I don't want to suggest in any stretch of the imagination that it was all me, but I certainly learned about healthcare from that perspective, and the need for things like patient advocacy, being physically present, how to care for loved ones, how to monitor medications, how to keep in touch with doctors, the issues associated, the complications associated with moving medical records, the issues associated with HIPAA, there were complicating factors, having a medical directive, and all these other issues. I then went from there into one of my accounts when I was with a little company up north called EDS, was Blue Cross Blue Shield. And so I learned a little bit of the technology needs of healthcare insurance companies. And then I went from there into advising through the consulting firm that I worked with, advising 8 out of the top 10 academic healthcare institutions in the United States. And then lastly, I had the fortune or misfortune, as the case may be, of being involved with a set of physician-owned, especially surgical hospitals that all were in a bad situation and had bad people involved in it. So I've seen the industry from a lot of different perspectives, and I said that there are basically 5 major muscle groups in the industry that need to be moved in order for everybody to be successful. First, we need to be much more focused and oriented on preventative care. Use your primary care physician far more aggressively. 2, we need to improve systems. That includes IT and accounting, so we have much more homogeneity and interoperability there. 3, we need to improve HSAs and their utility. 4, we need to really focus on pricing and make it less hidden. And then lastly, we need to focus on eliminating or reducing the hyperregulation. So that's what you'll learn about in the book.
Very good. And again, the book is the 60% Solution: Rethinking Healthcare. And Todd, we have a few more questions that have come in. If you have a few more minutes for us.
For sure.
So Tim in Carrollton asks if you have an opinion or insights into the health cost sharing programs versus traditional insurance.
Yeah, well, yes, I think those are also good ideas. Again, you're going to have some of the same issues, but you need to dig into the detail, make sure that you understand what you're getting into, because their healthcare sharing is very analogous to insurance. It just operates differently and with different loss ratios and different expectations. So I'd say usually it's a better instance than insurance itself, and it's probably not as good for those who have the ability to do so, to control their costs directly by self-insurance.
Understood. Another question from John and Debbie: at 65 on Medicare, how much can you contribute to an HSA yearly?
A couple can do right now for this year. And again, it changes every year, meaning it increases every year because of inflation. $7,200, I believe, is the number for 2021.
For a couple or for
Yes,
individual?
For a couple.
Understood.
And there's no limitation because you're over 65. The ability to contribute to your HSA does not go away.
Very good.
I want to make sure I got John and Debbie's question answered properly.
I do believe so. Thank you. And again, Todd, thank you for being on today. Again, the book is The 60% Solution: Rethinking Healthcare. It's definitely gone on my must reads list. Now, Todd, you've opened me up to some interests I didn't know I had, but a lot of changes out there. Also, the podcast he hosts is Civil Discourse. That's had great growth momentum, Todd. So congratulations on that. Again, we appreciate you. And for everyone who joined us today, I want to thank you for joining us. You can email us at service@lakepointadvisorygroup.com. If you come up with a question that you didn't get answered, please feel free to contact us. Our phone number is 214-771-3363. Thank you so much for being a part of today's discussion. We look forward to seeing you at our next Food for Thought discussion. Thank you, everyone. Have a great weekend.
Thanks so much, Josh.